Welcome back to Money Deconstructed, where we break down the complex world of finance. For decades, the US dollar has been the undisputed king, the bedrock of global trade and investment. It's what economists call an exorbitant privilege for the United States. But lately, whispers of doubt have grown louder, amplified by strange tremors in the markets early this year. We saw the dollar weaken even as US interest rates went up, something you usually see with shaky emerging economies, not the world's safe haven currency. So, is the dollar losing its shine? Is it truly no longer safe? Today, we're diving deep into the fears mounting over the dollar's stability, fueled by aggressive policy shifts, ballooning debt, global tensions, and the slow creep of de-dollarization. Let's deconstruct the dollar's uncertain future. Much of the recent anxiety isn't coming from overseas shocks, but from decisions made right in Washington, D.C. A dramatic shift in trade policy, combined with ongoing worries about government debt and questions about predictability, has created a volatile mix. Early 2025 saw what many called an unprecedented shift in U.S. trade policy. Citing national security and a massive trade deficit, the administration rolled out sweeping tariffs, a baseline tax on imports from everywhere, plus even higher reciprocal tariffs on specific nations. Some tariffs on Chinese goods reportedly soared into triple digits, sparking retaliation. International bodies like the IMF warned this pushed tariffs to levels unseen in a century, potentially echoing the disastrous Smoot-Hawley era that worsened the Great Depression. The predicted economic fallout was stark. Growth forecasts for the U.S. were slashed, consumer prices were expected to jump significantly, and business confidence plummeted. Retail giants warned of empty shelves and higher prices, raising fears of supply shocks and job losses. The odds of a U.S. recession climbed noticeably, but the dollar's reaction was baffling. Normally, tariffs might boost a currency by reducing import demand. Instead, the dollar sold off sharply, hitting a three-year low. It seemed investors weren't just reacting to the tariffs themselves, but to the perceived chaos and unpredictability surrounding them. The fear was that these policies would choke U.S. growth and make the country look less stable, less reliable. Major banks warned of a potential confidence crisis, and analysts began openly questioning the dollar's long-term reserve status. It seemed the very manner of these policy changes was eroding faith. This highlights a strange paradox. Policies meant to strengthen America domestically might be weakening the dollar internationally, chipping away at that exorbitant privilege, the ability to borrow cheaply and run deficits easily, because the world constantly demands dollars. If global confidence falters, that demand shrinks, potentially leading to a weaker currency and higher borrowing costs for everyone in the U.S. Adding fuel to the fire are persistent worries about America's massive federal debt, hovering around 120% of the country's annual economic output. While the dollar's global status has historically allowed the U.S. to manage this debt, faith is crucial. Legendary investor Warren Buffett recently called America's fiscal path alarming, pointing to reckless spending as a threat to the dollar's health. His stark warning about not investing in a currency heading for trouble resonated deeply. It wasn't that the debt suddenly became unmanageable, but the perceived risk of holding it increased when the issuer seemed less predictable. Further unease stems from perceived political interference in traditionally independent institutions. Public comments about potentially replacing the Federal Reserve Chair over interest rate disagreements rattled markets. Central bank independence is seen as vital for currency stability. Any hint of political pressure undermines the dollar as a stable store of value. Questions even arose about the future reliability of the Fed's emergency dollar swap lines to other countries, a cornerstone of global financial stability. This prompted talk of foreign central banks needing to pool their own dollar reserves as a backup, signaling declining faith in the Fed's unwavering support. It points to a broader erosion of trust, not just in specific policies, but in the very foundations of U.S. economic governance. Beyond domestic issues, the global landscape is shifting. Geopolitical fragmentation is on the rise. Tensions between the U.S. and China, the war in Ukraine, and other conflicts are forcing nations to rethink alliances and economic ties. We're seeing trade patterns change, with less commerce between geopolitically distant blocs. U.S. imports from China, for example, fell significantly in recent years, while trade growth between US-leaning and China-leaning groups slowed. In this climate, actions like widespread US financial sanctions and aggressive tariffs are seen by some as the weaponization of the dollar system. This perception has clearly spurred countries like China, Russia, and their partners in the expanded BRICS group to develop alternatives and reduce their vulnerability to US financial power. The IMF has warned that extreme financial fragmentation could severely damage the global economy, potentially more than the 2008 crisis. One tangible sign is the slow shift in the makeup of global foreign exchange reserves. While the dollar still dominates, its share has gradually declined over the past couple of decades, falling from over 70% in 2000 to the high 50s% more recently. The euro holds the second spot, around 20%, while other currencies like the yen, pound, and notably the Chinese renminbi, along with currencies like the Canadian and Australian dollars, have seen gradual increases. Perhaps more striking is the massive surge in gold buying by central banks. For the last 2 years, they've snapped up over 1,000 tons of gold annually, extending a 15-year buying spree. Key buyers include emerging market banks, particularly those seeking strategic autonomy or facing tensions with the US, like China, India, and Turkey. Many analysts see this not just as portfolio diversification, but as a strategic move towards an asset perceived as outside direct US influence and less vulnerable to financial sanctions. China, in particular, has been visibly reducing its reported holdings of US treasuries while boosting its gold reserves, possibly holding even more gold than officially stated. The search for alternatives extends to trade settlement. We're seeing more deals done in local currencies, bypassing the dollar entirely. Think China settling commodity deals with Brazil or oil with Russia and Yuan. Within the BRICS group, non-dollar trade settlements reportedly reached nearly $180 billion last year. China is actively promoting the renminbi, which now accounts for roughly half of its own cross-border transactions and a growing share of trade finance involving China. Alternative payment systems are also being built. While the SWIFT network remains dominant for bank communication, its limitations and use in sanctions have spurred alternatives like Russia's SPFS and China's CIPS. BRICS nations are working on BRICS Pay for local currency trade. Globally, efforts are underway to link domestic fast payment systems to improve cross-border efficiency. Looking at SWIFT data for international payments outside the Eurozone, the US dollar still leads by a huge margin, involved in nearly 60% of transactions by value. The euro is a distant second, followed by the British pound. Interestingly, the Canadian dollar and Chinese yuan were recently tied for fourth place, indicating the yuan's growing, albeit still small, role. Further down the road, central bank digital currencies, or CBDCs, could be transformative. Though still experimental, cross-border CBDCs could streamline international payments by cutting out intermediaries and settling directly, potentially reducing the dollar's role. Projects like M-Bridge, involving China and others, are exploring this. However, huge technical and political hurdles remain, and some worry CBDCs could also be used to evade sanctions. This move away from the dollar isn't a single event, but a slow, multifaceted process involving reserves, trade settlement, and building parallel infrastructure. While no single threat is existential right now, the combined momentum suggests a structural evolution is underway, driven by both economic efficiency and geopolitical goals like reducing vulnerability to US financial leverage. But despite these headwinds, don't count King Dollar out just yet. Powerful forces continue to support its global dominance. The primary pillar is the sheer size, depth, and liquidity of US financial markets, especially for US Treasury bonds. Global investors need assets they can buy and sell quickly in huge amounts without moving prices, and Treasuries fit the bill like nothing else. This is why, even amid diversification, most official dollar reserves are held in Treasuries. The dollar also dominates transactions. It's on one side of nearly 90% of all global foreign exchange trades, according to the Bank for International Settlements. It's used for the majority of international loans and deposits, and remains the main currency for invoicing global trade. This widespread use creates powerful network effects. The more people use it, the more useful it becomes. Underlying this are fundamental strengths: America's large, dynamic economy, relative political stability, strong property rights, rule of law, and openness to capital flows. Crucially, there's no clear successor waiting in the wings. While diversification is happening, no rival offers the complete package. The Eurozone lacks a unified bond market like U.S. Treasuries. China's renminbi isn't freely convertible due to capital controls. The Japanese yen market is heavily influenced by its central bank. Gold is impractical for large-scale trade settlement. And cryptocurrencies like Bitcoin are far too volatile and lack regulatory clarity to be a viable replacement, despite some seeing them as a potential long-term challenger if U.S. fiscal discipline collapses. The simple fact is, alternative assets aren't large enough to absorb the global demand currently met by the dollar. Finally, there's inertia. The dollar is deeply embedded in the global financial architecture, payment systems like SWIFT and CHIPS, over which the U.S. has significant influence. Shifting away is complex, costly, and slow. The Federal Reserve's role as a global lender of last resort, providing dollar swap lines during crises, further cements this dependence. Dislodging the dollar would likely require a major catalyst or a coordinated global effort, neither of which seems imminent. Building the trust and infrastructure for a truly multipolar currency system could take decades. So where does this leave us? The outlook is complex and uncertain, with forecasts reflecting the tension between forces challenging the dollar and those reinforcing it. Some analysts predict continued dollar strength, at least in the near term, citing U.S. exceptionalism. The idea that the U.S. economy will outperform due to factors like AI investment and productivity. They also point to the Fed potentially keeping rates higher for longer than other central banks. Paradoxically, some even argue the inflationary impact of new tariffs could force the Fed to delay rate cuts, further boosting the dollar initially. Others see a weakening trend, emphasizing the risks from trade policies, potential U.S. slowdowns, and capital outflows as investors react to uncertainty or seek better returns elsewhere. Many note the dollar already looks overvalued by long-term measures, suggesting more room to fall than rise. International bodies like the IMF reflect this uncertainty, highlighting increased global financial stability risks and raising the probability of a U.S. recession, directly linked to trade tensions. We're seeing increased demand for currency hedging from foreign investors worried about further dollar declines. Looking further out, CBDCs remain a significant long-term factor. If successfully implemented, interoperable cross-border CBDC systems could drastically reduce the friction in international payments, diminishing the dollar's role as the main intermediary. But the technical, regulatory, and political challenges are immense. Their impact is likely years, not months, away. As experts suggest, the focus perhaps shouldn't be on predicting the dollar's fall, but on managing a gradual transition towards a potentially more multipolar financial system while maintaining global stability. So, to answer our initial question, is the dollar no longer safe? The narrative captures a real shift. Unpredictable U.S. policies, geopolitical fractures, and diversification efforts have undeniably introduced new risks and chipped away at the perception of the dollar as an unshakable safe haven. The strange market behavior, the gold-buying spree, the exploration of alternatives, these are real signs the dollar's absolute centrality is being questioned. However, reports of the dollar's demise are premature. Its dominance is anchored in deep structural advantages, unmatched market liquidity, the lack of credible alternatives, and the sheer inertia of the global system. A wholesale replacement isn't likely anytime soon. The key takeaway is that the safety and predictability associated with the dollar are genuinely in flux. The risks have risen, driven significantly by domestic policy choices and a changing global power balance. While King Dollar's reign continues, its foundations face unprecedented pressure. And perhaps the very conversation we're having now, amplified by market jitters and policy shifts, will itself shape the outcome. Confidence is everything in finance. If enough global players perceive the dollar as riskier and act accordingly, that narrative, fueled by real events, can become a force in itself, potentially accelerating shifts in the global financial order. The stability of the world's dominant currency is no longer a given. We are navigating a period of profound uncertainty, That's all the time we have for today on Money Deconstructed. What are your thoughts on the dollar's future? Let us know in the comments below. If you found this breakdown helpful, please hit that like button and subscribe for more deep dives into the world of finance. Thanks for watching, and we'll see you next time.